Different types of quotes. In financial market, generally we will be able to see single price quotes and two-way price quotes. Here, the single price quote generally refers to the price at which the last transaction took place. One easiest example for this would be the last traded price of a stock. In This is the if you have seen tickers in stock market, the price that would keep changing of the stock prices, that price is shown, the price that shown there is the last traded price of that stock in the last transaction that took place in the market. When it comes to foreign exchange market, they use two-way quotes. Two-way quote means it shows both bank buying and bank selling rate. This in technical term it is known as bid price and ask price. Bid price means the price at which bank is ready to uh, buy your for the foreign currency you have, and the offer or ask price is the price at which bank is ready to sell you the foreign currency. That's it. Now let's try to understand spread with an example. Suppose you have $100 in your hand. Then when you want to sell the $100, the bank will take it at the bid price. Let's say 72 rupees per dollar. Now, in a situation where you want $100, the bank will sell you the $100 at offer price. Let's say 72.5 rupees per dollar. Thus, the difference created is the profit generated by bank, and this difference is called a spread. Spread is often expressed in percentage. Spread equal to the equation will be bid minus ask, then divided by the denominator will be bid again, and multiplied by 100. Cross rates. If the home currency is not involved in the quote presented, then it is known as a cross rate. It is easier to understand with an example. In India, if euro is quoted against pound, as Indian rupees is not involved, this can be a cross rate in India. In international forex market, anything that is not quoted in US dollars is expressed as cross rate. So what this means is, in cross rates, one thing is home currency will not be involved. Another thing is, in general sense, it's not quoted against US dollars. Pips. Pip means price interest points. If no, it notes the smallest unit by which a currency quotation can change. If you are familiar with tick size in stock market or in stocks, pip works the same way in forex market. In general, it is measured up to 4 decimal points. So 7 pips forward movement in used INR means from the previous quote price, the price has moved 0.007 in value. A simple example will be, if USD INR is at 72.69, and if there is 18 forward pip points movement, then the value of the USD INR can be achieved by the following calculations. Like the base will be 72.6900, and then we have to add the pip, and we have to make sure that there is 4 decimal points in the value 18. So when we are applying 4 decimal value to 18 pip, the 18 will become 00.0018, and then we add base and then we add the pip points, we will get 72.6918. Forward rates. Spot rate means the rate in which a transaction is taking place now, and forward rate means the rate in which a transaction will take place in future. There will be difference between spot price and forward rate. Spot rate and forward rates. This difference is known as swap points. It is also in forex. It is also called as forward margin or FS differential. That is a forward spot differential as well. The swap points are given as 55 by 65, 45 by 40, or 18 by 90. Like this, it can be given. So if you're looking at it, you can see that it can be in ascending or descending order. If it is in ascending order, it means the currency will be trading at premium from spot price. Similarly, if it is in descending order, it means currency will be at discount from the spot price. Example will be 47 by 50 swap points means ascending order represents the currency that has a premium forward rates. 30 by 20 swap points means it's in descending order. It represents the currency has discounted forward rates. Now let's look into a calculation method in swap points. Spot price is $1 equal to 72.000 bar 72.0010. This is two-way code, and swap points 3 months is at 50 bar 70. So it's in ascending order. So we can here simply easily calculate by adding the pips. The forward rates would be 72.0050 bar 72.0080. What we did here is we simply add the pips 50 and 70 to the spot rate. Suppose the spot rate is $1 equal to 72.000 bar 72.0010, and the swap points is 2 months 10 bar 05, and it is in descending order. Here the forward rates will be 72. Then we have to deduct 0.0010 pips, and we will arrive at 71.9990. Then we again have to deduct 72.0010, and we have to deduct 00.0005, and we will arrive at 72.0005. Here the forward rates will be 71.9990 divided bar 72.005 will be the forward rate here. In ascending order, we will simply add the pips. If it's in descending order, we will simply deduct the pips.